Hello, everyone, and welcome to another episode of 9x90. Today, we have with us a very interesting guest. He's visiting from Australia, although he has been a transplant in the US for about 25 years now.
Something like that.
Yeah. Ian Drewe has raised hundreds of billions of dollars through the structuring and execution of high complex global investment banking transactions for governments, institutions, and major corporations. After years at the highest levels of global finance, he now brings the same level of discipline and analytical rigor to US-based investments in property, healthcare, and banking. And he is now the founder of something called Avoka Property. Ian combines institutional grade analysis with entrepreneurial execution, currently backing innovative ventures like in healthcare and banking. Ian, thank you so much for coming on the show.
Adi, thank you so much for having me. It's a pleasure to be here.
So you've raised hundreds of billions globally. What principles or patterns from that experience translate best to raising something like a 200 million fund today?
Well, the short answer is a lot. I think a lot of the principles that we have, or that I have kind of run my business over the past 20 years, just translate to a fund today. The most, I guess, the first and foremost, conservatism, thoroughness, and transparency in everything that you do. Don't pretend that the risks don't exist. Acknowledge them and run through them openly and analytically as to how you're going to mitigate them. As part of that, do your sensitivities. You need to show your client the results of various assumptions don't pan out, particularly those of a macro nature where you don't have control. I would say hedge your risks where you can. An absolute axiom then and now is have the best team of trusted advisors that you can get. I'm not sure that a lot of people necessarily see the value in having the right advisors, but we really lived and died by them, and I still maintain that as an absolutely fundamental tenet. And I guess lastly, at the risk of stating the obvious, nothing changes from the principle that you have to know your stuff. In any situation, any meeting, you have to be prepared. You have to be ready to answer questions on countless eventualities. And I guess this sounds kind of odd, but it's something. It's kind of my personal bugbear. That if you don't know something, then just say that you don't know it. And that
oh my God, I know.
I've seen so many people clearly not know an answer and continue to talk about something else in the hope that people will somehow not notice the fact that they don't know the answer to the original question. I swear it's a strategy that never pays off.
No. I was in a pitch meeting the other day, and one of the top M&A attorneys in the country was there, and this kid is going, and nobody knew that he was past special ops, and this one young guy kept going on and on about what the US government is doing wrong with military presence in a country.
Oops.
Where he had prior experience, and I was just like, oh. And I looked at him and he shook his head like, don't say anything. He just got up and walked out. And it was just like, okay.
Oops.
Yeah.
I mean, we're going to make mistakes. God knows I've made a million of them. That's okay. It's when it's so obvious that you don't know an answer, right? And then people try and just talk around it. They take the approach of, well, if I just continue talking about something, then I'll get away with it. Never works.
It's so illogical, because when you're wasting time talking about something you don't know, you lose the time that you would have had to talk about things that are actually of value. Like, I was speaking with an investor the other day, and he was asking about the real estate development opportunity in the US for building power grids, because I guess in China they're adding tetrabyte or something of power to their grid every month, and in the US we're not. Mm-hmm. And I was like, I'm going to be honest with you, I cannot even hold my own in a conversation, and I'm pretty sure I just got half of the jargon wrong. Like, if that's what you're looking to invest in, I cannot help you. But if you want medical office space near hospitals, I could talk to you for like generations about this. But yeah, I agree with that completely. I've seen that on my side as well. So you, when pitching complex investments, how do you frame risk in a way that institutional LPs have found both intellectually sound and emotionally acceptable?
Wow. Well, firstly, fantastic question. Emotionally acceptable is really interesting, because I can tell you right here and now, if it works, it's generally emotionally acceptable, and if it doesn't, I've seen a lot of people be less than emotionally stable. But we'll try and give you a better answer than that. So, the transactions that I guess I have done in various teams have run the full spectrum along the risks scale. So my last role was with a well-known American bank here on Wall Street, and we underwrote investment-grade bonds. Prior to that, I did some corporate loans. The other extreme, I guess, which was the majority of my career, was when we did cross-border transactions that sought to arbitrage different countries' tax, accounting, or corporate laws to either mitigate tax or possibly obtain some other benefits, such as, I don't know, a better regulatory capital treatment. Now, those transactions were inherently extremely risky at so many levels, including reputational risk for our bank and for the client. So in that situation, for every possible risk, and there were many, we took two kind of broad avenues. We obtained opinions from really well-respected lawyers and accountants for the technical stuff. Yeah. Where we could get them, we sought advanced rulings from any given country's tax authorities, again, where we could. And internally, we were required to obtain approval from heaven knows how many credit, risk, tax, investment, and a plethora of other committees. In certain institutions, we, again, because of the nature and the risks associated with the transaction, we had to get direct approval from the CEO, which was always interesting. Yeah. So our clients knew this. And they found, I think, comfort from the fact that we had the process both internally and externally. And I think that, I was very lucky, because the institution with whom I was with, their reputation was also key. So they weren't necessarily looking at me personally. I was a member of a team. I had the banner of an institution, and if it was a well-regarded institution, that certainly helped. I will say that process, as much as we hoped that it would give clients a level of comfort, it was not infallible. I was part of institutions which got it really, even with all of the levels of approval and all of the resources that every institution has at its disposal, they can get it badly wrong. Now, we've all seen it in well-documented, well-publicized occasions.
Well, because they love to well publicize it whenever someone gets something wrong at a high level.
Well, they sure do, because often, I've seen instances where, even with those levels of kind of internal safeguards, banks make incredible decisions. So I was working in an institution which I think was a little bit of a fish out of water. They were this was in London at the time. They were from another country, and they were a relatively small local bank in the other country who decided to jump into investment banking. And so what they do is they go and they hire and spend a lot of money attracting across a very well-known banker to join their team. And as part of her compensation package, she was allowed to take equity positions in the same transaction that the bank issued debt. Now, I've never seen, for very obvious reasons, I've never seen anyone, or never heard of that in any major institution, certainly none of whom I've worked. There's an obvious, huge conflict of interest. And sure enough, it came back to bite them. So in one transaction where the bank and I think a syndicate of banks lent over $1 billion, the borrower defaults, and bizarrely, still, they hadn't worked it out. This lady was then tasked to lead the workout and the bankruptcy negotiations. But of course, with her position as an equity holder, in direct contrast and direct conflict with the lender's position. And yet there she was representing both interests. And funnily enough, it didn't work out. And in fact, because of that, the whole institution folded. She ended up walking away and being a very well-paid banker. But the institution lost pretty much everything, lost a huge chunk of its balance sheet, and ended up being swallowed up. So You know, banks are not infallible. I mean, I don't need to say that. Institutions are not infallible, funds, insurance companies. But, you know, we do, certainly when we were there, they have certain certain committees and processes in place to ensure that that kind of stuff doesn't happen, but occasionally it does.
Yeah. One of my godfathers, he participates in those syndicate structures where they lend billions.
Yep.
Yeah. So I got to learn a little bit about it when we did a sunset sale a couple weeks ago, and someone was trying to get in on the deal, and he was like, I have been in banking for 45 years before I got a seat at this table. You're not even 45 years old. You're not getting a seat at this table. And the kid was like so upset. And I was like, look, I told you I'd get you on the sunset sale with my godfather. I did not promise you would be able to work with him on anything. But yeah, it's I think what they're doing there with the syndicates backing debt, I mean, it's so much can go wrong. You can crash entire economies. You can have a lot can be lost when the wrong people make the wrong decisions.
Yeah, absolutely. I mean, I think a syndicator has one of the toughest jobs, be it in equity or debt, because not only do you have to go through your own internal processes, you then have to guide the various other bankers, the various members of the syndicate through their processes. And I couldn't think of anything worse. Thankfully, I had a team of syndicators who were responsible for doing that. And so I was, you know, I was in a very fortunate position where I didn't have to do much of that, but I couldn't think of a tougher job.
I have, with my fund, if someone has like, we oversubscribe to give ourselves a buffer. So if someone has like a personal emergency or something happens, there's a war in their country for whatever reason, they can no longer fulfill the capital call. We can restructure things so that it's not hurting anyone. It's also not hurting our progress. And this one gentleman from another fund, he was like, well, how do you do that? And it was like, I tell the lawyers to take care of it. What do you mean? How do we do that? Say, look, something came up. We want the long-term relationship. Make this work so it's fair for everyone else. And they were like, well, what do the terms look like? And I was like, I have no idea. I get really good attorneys that I can trust to make sure that everything stays fair for everyone. But like, I'm not going to pretend I'm the attorney or anything else. Like, it's thank God for them.
Well, there's a great expression which I hadn't heard prior to coming to the US, which is staying in your lane, and you know, it's all about doing that. And again, at the risk of kind of, you know, flogging your dead horses, we would say, it goes back to not pretending that you know what you don't know, right? So if you're not an attorney, just say, it's my attorney's looking after this. So it's, you know, it's simple stuff. People try and pretend they know stuff. Never ends well.
Yeah, it's like, I'm not messy. I'm the soccer coach that's on the sidelines making sure all of my all-star players are where they need to be, but then I trust them to do what they know how to do. I can't kick the soccer ball. I could just make sure they're there in uniform, trained, have their equipment they need, and they're ready to go. That's it. But yeah.
Well, I think there's at least 50 books that would support that position, right? On how to run a business. It's how to delegate, and that's a skill in itself.
Yeah. Well, I think the skill is finding the right advisors and trust, and then taking a step back and trusting them to do what they do best.
Yeah, and to me, that's been the key really to my career. And in fact, that got me through so many doors where a potential investor, a potential client may not have heard of me, may not have had much of a relationship with the institution with whom I had. But the very fact that we have advisor X, let's say it's a lawyer, you know, Bill Smith is our lawyer. Often his or her reputation will get us through the door, because he or she is on the transaction, likes the transaction, is putting their name to the transaction. That speaks volumes. And so it's not only the kind of, you know, the need you have yourself to get it right. It's also a great way to attract investors, is to have the right attorneys, the right accountants, the right advisors.
Yeah, absolutely. We have one of the law firms we work with. I didn't know them from Adam, but a very, very good legal ally and advisor over the years that I met through my business school alumni network. they hired him. So now they got all of the IE business school alumni clients with it. I don't even know if they realized that when they took him, that like all of his clients would be following him over to their firm. But yeah, it's once you find a good person that you trust, it's great to stay doing deals with them.
It's absolutely absolutely crucial. Now, I don't know your friend nor the firm, but I'd be staggered if the firm didn't know that they'd be getting a whole bunch of clients when they hired him.
Yeah, they were pleasantly surprised.
Right.
So you've worked on structured deals at the highest level. How should emerging managers think about capital stack design, incentives, or preferred returns in a way that protects the downside but still attracts capital?
Yeah. Gosh, great question. I think that the best way to answer this is perhaps not to get into the weeds, and just to say that when you are structuring a deal, I constantly have to remind myself really of two things. The first being that, particularly now that I don't have a bank moniker over my head, that investors are looking at me more than ever, that I'm asking investors to part with their hard-earned funds and to trust me. And really, that's a big ask, right? When you don't have the brand name of an institution, and when you're asking investors to really trust you personally. So that being said, that's a foremost consideration when I'm sort of structuring capital stacks and compensation, put myself in their shoes. In turn, I think a lot also depends upon the experience and the expertise of the sponsors. So recently we've been battling with some interesting transactions where the transactions themselves are phenomenal. The business brand, the business idea, the business plan is amazing, but the sponsor group perhaps isn't necessarily as experienced as you may have. So it's a battle to say, look, this is a factor, this is a consideration. And I think ultimately that mix will determine what you can and cannot ask your investors to accept. The second part is, I guess, which is obviously competing, is that you also need to ensure that there's incentive for the sponsors and the operators I should say, to execute the business plan as promised. So I think it involves more than skin in the game, which is an obvious one. And at the moment, I think the market is headed, particularly now I'm talking about sort of the multifamily real estate market. Is an interesting place, because at the moment I'm seeing some really crazy stuff where the splits between investors and sponsors for certain waterfalls are approaching 100 to 0. Sponsors are essentially living just off whatever upfront fee they can get, possibly something at the back end, although sometimes nothing, and really not much else. And initially what that does is that sounds great to an investor, right? So an investor will look and they'll see the initially kind of proposed numbers off a base case. The numbers will inevitably look very, very healthy. But scratch the surface and you'll see that really the investor is taking an enormous risk. And the risk is that the sponsor will spend the time and resources to execute the business plan when there's really nothing in it for them. They've got their upfront fee. I don't know how much skin in the game they may have. And it may be that, that sponsor will jump to the next transaction, get their upfront fee, and so on and so on. So there has to be a balance. If you're an investor, I think you really do need to ensure that there's enough in it for the sponsors, in addition to the skin in the game, in addition to what they've invested, to ensure that they're going to spend the time and resources needed to, again, ensure that investors will get the returns as promised. Because if there's not, huge risk, and it has happened.
No, I could not agree with you more on that. I had someone reach out the other day, and he was like, what is your arrangement with your godfathers? Because I have mentors and advisors, and after I've known them for so many years, I just introduced them at events as a godfather. And I said, well, typically what happens is I ask for advice on deals where I know it would be a win-win situation for them to give me the right advice. And I structure it that way so that I know we both have skin in the game for them to guide me correctly. And he was like, oh, well, I don't need a win-win. I just want to help you for free. It was like, if you're not benefiting from helping me directly, it means you're doing something sketchy behind the scenes. And I don't trust you. If I don't see an explicit way for you to financially benefit from helping me, I don't trust you. And he was like, you don't trust someone who wants to help you and have nothing to gain. And I was like, that is completely accurate. And anyone who is going to blindly trust someone who's going to give them things for free with zero benefit is like, I don't know, a child. Like, it just doesn't exist. It just doesn't exist. Like, they're like, we've seen enough. Okay, in Australia, you have those like very real children's stories where like, it's like, look, and the child went in the water and they were eaten by an alligator and died. And like, we don't have that in the US, but we do have the horror stories where like the princess blindly accepted an apple from a stranger, bit it and died. Like, we're taught from a young age, if someone's giving you something for free or for very low cost, like, do not trust it. Do not trust it. There was someone pitching me syndicates yesterday. I was like, where do you make your fees? And he was like, on the acquisition and the disposition. So when they acquire it, they get their fees. And then when they sell it, they get their fees.
Yeah.
Like, okay, so you buy it, you look to spike value as fast as possible, and then you flip it. So they're basically, instead of flipping single family homes, they're flipping like gigantic, like 200 unit property or large office building or something. Flipping at a larger scale. And I was like, but if you had a fund structure instead, you would hold on to it and continue to get the cash flow coming through. And you wouldn't just be looking to flip buildings, you would hold them for longer. If like they're all like, you already have a valuable asset, why are you going to flip it? And he was like, well, where do we get our fees? And I was like, you have your 2 and 20, classic 2 and 20, rather than constantly being motivated to buy, sell, buy, sell, buy, sell. And he was like, well, I've never done a fund before. And it was like, I like your deals. I would like them better if you had a fund structure, because then it would be clear for me, like, and I wouldn't be worried about you selling assets prematurely and things like that, you know?
Yeah, absolutely. I mean, it's interesting going back to what you're talking about. I mean, it is kind of sad. In a perfect world, I would rather be that naive 25-year-old. I was probably naive 35-year-old who actually trusted people. But I've seen I've seen so many people burnt because the incentive structure was not lined up correctly in whatever situation across a raft of situations. And you'd like to believe, I would love to believe that the world worked differently than it does, but it doesn't. Now getting into slightly political stuff there, so no one wants to hear an Australian's political views who are living in the US. But it took me a long time to work out what you just stated is absolutely true. You need to have both. You need it to be a win-win, right? You need to have both sides having an incentive to do the right thing because they co-align. One works with the other. You need the sponsor to do a good job for the investors to get their returns in the sort of the classic multifamily situation. If the incentives aren't aligned, ain't gonna work. Simple as that.
Yeah, absolutely. So at your scale, I should say, it's not that people don't want to hear politics about Australia because we're in the US. The audience is in 56 countries. We just try to stay away from politics, period, on the show.
Oh, well, then we have a double reason. You are. I have nothing good to say or of any value whatsoever about politics in any country. You're safe.
Oh yeah, it's a complicated topic. We just avoid. Leave it for Megyn Kelly.
Exactly. She does it far better than I.
Oh yeah. So at your scale, managing investor relationships, it obviously required systems. How did you scale investor trust building without losing authenticity?
Yeah, okay. So this is really showing my age, Adi. But when I was kind of in the throes of my banking career, we really didn't have much of a CRM system of any description with which to work. The scope of clients with whom we worked for any given transaction was really finite. It was well known. The key decision-making people were well known. And so, we tried to get a group of clients and to repeat business because our internal people knew them, and that made our life easier getting stuff done and getting through the approvals process internally. What would inevitably happen would be if we went into a country or into an industry where we didn't have any history or we didn't have any pre-existing clients, then I'd say 50% of the time it would be through an introduction. So there would be something there. The other 50% of the time we would have a connection, and this is where our good old advisors would come in. People were happy to take a call from Ian Drewe from Institution X if I had with me, again, let's go back to Bill Smith, our friendly lawyer, Bill Smith on our team, because that client would know of Bill either directly or through reputation and know that whatever Bill touched was sensible. And so that's really how it wasn't difficult to get meetings. The trick again was, once you got that meeting, to come up with a structure and with a pitch, again harking back to all the stuff that we spoke about earlier, where if you showed people that you were openly examining the risks of the transaction and that you were explaining how to mitigate those risks where you could, acknowledging the risks where you couldn't, generally we were okay. We developed at the very least a relationship with the investors, and I think that's the key. If you're open, you're honest, you're transparent, and it's clear that you know your stuff and it's clear that you've done the work, you're going to get a meeting. So it was simple. Now that I'm on my, I'm not on my own with Avoka, but obviously it's a different situation. I'm in the same situation as many. We use several CRM systems to automate the process. The challenge is really to balance the automation and the effectiveness of a system to allow you to reach as many people as you can and in an effective way as possible. With that, I guess balancing it with, as you put it, the authenticity, the connection, and that's a constant challenge. If I'm not speaking with an investor enough, I know that I'm going to lose that relationship. So it's working out how to do that effectively, and it should be that way.
Yeah, absolutely. I have for our CRM, I have people ask me about how they can get access to the deals that I like, and then I put them into the CRM as maybe interested, and then I send them the overall fund deck and a target asset preview, and then if they say they like that and they want more information, then I switch them to interested. Or if they see it and I follow up and they don't respond or they're not interested, then I switch them to not interested and just leave them. But yeah, it's like a marketing funnel. It's people are trusting you, or they're trusting one of your decision makers. And then you have, like with all businesses, it's the customer acquisition and the customer retention, or in your situation, the investor acquisition and investor retention. Once you have a good set of investors that you can retain, you don't have to spend so much time acquiring anymore.
Oh yeah, whole science out there, right? Of the attributes of the investor that will invest with you and your firm, and it's fascinating. It's absolutely fascinating. Again, not something that we looked at pretty much at all in my banking career. Would have made for an interesting study. There were some interesting characters with whom we dealt. We were interesting characters. But now I find it fascinating. There's entire books, reams of information on the kind of characteristics and attributes of an investor, which is again well beyond my level of capacity, but it's fascinating, absolutely fascinating.
Yeah, there's a book by Hunter Thompson, which he breaks down investors into like 5 archetypes. I haven't read that chapter yet, but I guess for those of you wondering, that's a book recommendation. Let's see, 3 questions left. What would family offices or first-time allocators what should they know before entering healthcare, or you said you're focused on finance right now? Healthcare and finance?
Healthcare, property, and finance. Yeah.
Okay. So healthcare or finance with an institutional lens.
Okay. So look, there's a lot there. I would say, speaking very generally, and I'll start with multifamily property because for us, really, that's our bread and butter. So if an investor is looking at it for the first time, and I guess this also applies to assisted living and rehabilitation clinics, which is the healthcare arm of what we're looking at. Really, one of the first tenets is that prospective investors should be aware that really the industries are recession-proof, and that's a big call. But let me explain a little bit more. So on the multifamily side, unfortunately, there's a chronic shortage of affordable housing in the US, and that kind of disappears from the headlines for very obvious reasons at the moment, and aligned with the fact that people need somewhere to live. Both of those statements will sadly remain, not necessarily that people need somewhere to live, but the fact that there is a chronic shortage of affordable housing, both those statements will ring true for a considerable period of time. And what that means is that as an asset class, it's far less, it fluctuates less wildly than, a lot of the other asset classes out there, particularly those that are market-based. And so if you understand, if you acknowledge that there is a real need for what it is that we and our investors are providing, then it's worth exploring. I think the secondly, healthcare, and by that I mean, and healthcare of course can mean anything, but for us it really means sort of the gamut from assisted living through to intensive rehabilitation clinics, and there's a lot of different levels in between. Again, sadly, but the reality is that people are going to get sick and they're going to need to be rehabilitated, regardless of whatever else is going on in the world. The other beauty of that asset class is that your source of income is predetermined. It's tabled amounts from both government and from insurers. So if you start with kind of those two tenets and think, yeah, that's interesting, I would posit it's definitely worth acting as a catalyst for an investor to take a further look.
And then if people would like to get involved with one of the deals that you're working on now, how would they do that?
I guess the two ways to reach me. The first is go to our website, which is avocaproperty.com, AVOCA, property.com. My email address is info@avocaproperty.com. Either of those two ways, I would love to talk to you about what it is that we've just done. Very good point, Adi, which I haven't mentioned, which is that we also have a really interesting banking transaction where we're launching a community bank, and for the right investor, it's a really interesting transaction. I won't go into it now, but please reach out.
You totally should go into that now because there are several banking executives who listen to the show.
Okay. Well, I guess this is a minority-owned community bank that is launching in Cobb County in Georgia.
Okay.
And there are some very specific regulatory and legislative, legal, shall we say, benefits that accrue to the sponsors of this particular transaction, which flows through the base case numbers to investors that make it very attractive. So again, it's not what I would call a normal community bank, if there is such a thing. There are very specific and well-entrenched laws that dictate that the returns for this bank should be in excess of what one would consider from a normal banking perspective. And without going too much into it, That plus the tax advantages associated with investing at an early stage in the bank, should hopefully make it of interest to the right investor. And I would absolutely encourage anyone who is interested in coming to a financial institution in an early stage capacity, a great opportunity here.
What is the minimum investment size?
I think for this one, the minimum investment is 100,000. The total ask is, I think they're seeking around 20 million. Yeah, so I think that's 20 million in lots of 100,000.
20 million to get a bank started. That's pretty cheap.
It's incredible. And I must admit, Adi, I thought exactly the same thing. But essentially, what they're doing is the particular play with this bank is that the laws dictate that they have an advantage. They must be given a certain amount of deposits from insuring businesses and deposit takers, and that will mean that 20 million is sufficient to get the bank up and running, and to have something started. Because their ability to attract deposits is helped from a legal and tax perspective.
And then is the idea that this bank will eventually grow into a major player within the US market, or are they hoping to be acquired?
They're hoping to be acquired. I think that this is going to stay a community bank. That's where its strengths lies. That's where the strength of the sponsorship group lies. That's where the focus of the business plan is. I think that any notions that they would look to really get anywhere near challenging any of the larger, more established national and international players would be fanciful. So no, their business plan is to very much focus on serving the needs of the community. And as I said, the law dictates that if they stick to that, they're in a good place. Okay.
Well, you all will have his contact information, Ian's contact information in the show notes, and you have now gotten to hear a few insider tips for those of you launching your own fund, and about one very cool finance. I won't say fintech. I was about to say fintech. We've had a few fintech founders on here. A very cool banking opportunity that is in the United States. Thank you so much for your time. I appreciate it.
Adi, thank you. I've had a ball. That was a lot of fun. Thank you so much.
Well, I will see you all back online. Until next time. Bye.